In this video, I'm going to show you 3 simple but powerful option strategies that any beginner can use to make their portfolio work harder. Let's not waste any time and let's jump right in. The first strategy is called a covered call. Let's say you own 100 shares of Google and you'll be happy to sell them at $320. Now, you could just set a limit sell order at $320 and wait. But with a covered call, instead of just waiting, you could sell a call option at $320 and collect a premium upfront. Then, if Google hits $320, you will sell the shares at $320. But if it doesn't, you get to keep your shares and sell another call to collect another round of premium. Essentially, you are getting paid to sell your shares at the price you were already okay with. Now, in order to do a covered call properly, you will need to own at least 100 shares first. That's what makes it covered. If you try to sell a call without owning the shares, that would be called a naked call. And being naked isn't always a good thing, especially in this case, as it can lead to huge losses. So, how do we actually set this up? The first thing you need to decide is when the options expire. You can choose any expiry that you want. But Tasty Trade did a study on the S&P 500 since 1993 and found that below 45 days, option sellers have no edge. But from 45 days onwards, the premium that you collect is consistently priced higher than the actual risk. So if you want an edge, you could go 45 days or more. On top of that, try to avoid selling calls over the earnings period. That's because stocks can be extremely unpredictable around earnings and can get past your strike overnight. For example, you can see here that Google often overshoots the expected move during earnings. So if you sold a call before this, you could easily get called away and miss out on potential gains. Anyway, for this demo, I will just go with 38 DTE, which is on May 1st. Next, once you have selected your DTE, the next thing is to pick your strike. This is the price that you'll be happy to sell at. On Moomoo, if you open up the charts, you can turn on this feature called Market Position Overview. Essentially, this shows you where most shareholders bought in. And for Google, you can see that there's a cluster of resistance around $315 to $316. Additionally, if I toggle on the simple moving average indicator, you can see that the 50-day moving average is also around $317. When two indicators line up at the same time, the stock will likely have a harder time breaking past it. So let's select the $320 call. By doing so, I get to collect a premium of around $570. Google is trading at about $299 right now. So if you do the math, $570 every 38 days would work out to about 18% annualized. That's actually quite a decent return for doing almost nothing. Now, there are 3 scenarios that can happen. If Google drops or stays flat, the option expires worthless and I get to keep the $570. I still own my 100 shares and I can just sell another call again to collect another round of premium. But if Google rises past $320, my 100 shares will be called away at $320. But I still get to keep the $570. This is fine since I'm selling away my stocks at a price that I was already happy with. But if I ever change my mind and I don't want to sell anymore, I can actually roll my option. That just means I buy back this call and sell a new one at a higher strike or a later expiry to avoid getting called away. Now, one thing I really like about Moomoo is that it has a built-in AI assistant. So if you are ever unsure about whether now is a good time to sell or not, or what strike to pick, you can just ask it. For example, I can type in, I own 100 shares of Google and I want to sell a covered call. Based on the current IV, upcoming earnings, and price action, is now a good time? And it comes back with a few suggestions. For example, it says that if I want to be conservative, I could go 12 days out with a $305 strike. And if I want to be a little more aggressive, I could go 55 days out with a $310 strike on May 15. It even wants me to check if earnings fall within the expiry, which is exactly what we have talked about earlier. So that's nice. Speaking of options, if you are looking for a platform to start trading options, you can check out Moomoo. One thing I really like about the platform is the strategy builder. So if you are not sure which option strategy to use, you can just select your outlook, set your target price and budget, and it will recommend strategies for you with a clear P&L chart showing your max profit, max loss, and break even. It's a really helpful tool, especially if you are just starting out. And right now, new options traders on Moomoo get 0 commission for 6 months. They also have an Options Pro Bootcamp where you check in daily, read through their option articles and courses, and you can earn up to $38.80 in option cash vouchers. If you are new to Moomoo, you can use my link in the description to sign up and get up to $1,864 in rewards, which includes a $100 NVDA share exclusive for my channel. Simply follow the steps here and key in my promo code to get your exclusive reward. Moving on to strategy number 2, the cash secured put. Let's say you have been looking at NVIDIA for a while, but at $176 a share, you think it's a bit pricey. You would rather buy at $165. So instead of just setting a limit order and waiting, you can sell a cash secured put at $165. By doing so, you get to collect a premium upfront. If NVIDIA drops to $165, you get to buy at the target price that you want, plus the premium that you collected makes your effective price even lower. On the other hand, if the stock doesn't drop, you get to keep the premium as free income. So think of it as a limit buy order that pays you while you wait. Now, here's the most important rule. You should only sell puts on stocks that you genuinely want to own. That's because if you get assigned, you'll be buying 100 shares. So make sure it's a company or ETF that you'll be happy holding for years, and not some meme stock that you panic sell the moment it drops 50%. For the expiry, it's the same idea as covered cost. If you want that seller's edge, go with 45 days or more. But since you are picking a price that you happily buy it anyway, any expiry would work. So I'll just go with May 1st, which is about 38 days out. Now, how do you decide what price to sell at? There are 2 ways to think about it. First, you can look at the chart and find a technical support level. That's the price the stock has bounced off before, which makes it a natural entry point. For NVIDIA, the market position overview doesn't show much support below $173. But if I toggle on the SMA indicator, the 250-day moving average sits at about $166. That's a long-term support level. The second approach is intrinsic value. Instead of just looking at the chart, you could look at what the stock is actually worth based on its fundamentals. Then, you go sell a put at or below that fair value, so that if you ever get assigned, you are buying at a discount. On Moomoo, you can find this under a company, then Morningstar Research. And according to them, Morningstar's fair value is $260. And if you tap in, you can find a lot more detail. How they arrived at that number, the bull thesis, bear thesis, and even the full report itself. Another site I often use is Guru Focus. For example, if I assume a 25% EPS growth rate, NVIDIA's fair value would come out to about $206. At my $165 strike, that gives me around a 20% margin of safety. So let's go with the $165 strike. By doing so, I get to collect around $450 per contract. The delta is 0.29. That tells us there's roughly a 29% chance that I will get assigned. So if I do get assigned, my effective buying price will actually be $106.50. That's $165 minus the $4.50 premium. Now, again, there are 3 scenarios that can happen. If NVIDIA stays above the $165 strike, the option expires worthless and I get to keep the $450. Then I could just sell another put to collect another round of premium. But if NVIDIA drops to $165 or below, I will get assigned and buy 100 shares at an effective price of $160.50. That's a price I was already happy with, and the premium made it even cheaper. But if I change my mind, I can always roll to a lower strike or a later expiry to avoid assignment. Either way, I get paid to wait, or I buy at the price that I wanted. So that's a win-win. And again, if you're unsure about the timing or the strike, you can always ask Moomoo's AI. For example, I want to sell a cash secured put on NVIDIA. Based on the current volatility, upcoming earnings, and recent price action, is now a good time? And it comes back suggesting a $170 strike with $165 as an alternative, which lines up with the 250 moving average support that I found earlier. For the expiry, it suggests April 17, which is about 25 days out. So that's cash secured put. Instead of a cash just sitting in your brokerage account doing nothing, a cash secured put lets you earn premium while you wait for the right price. The last strategy is called LEAPS. Let's say you're bullish on the market long term and you want exposure to triple Q. With LEAPS, you get to control 100 shares at a fraction of the cost. So for example, instead of paying $58,800 to own 100 shares of QQQ, you could buy a long-dated call option or LIPS to control 100 shares at just a fraction of the cost. Then if the underlying goes up, your LIPS goes up almost dollar for dollar. But if it drops, sure, you lose money too. But your max loss is capped at the premium that you paid for the option. So instead of having the full $58,400 at risk, you risk a much smaller amount. Here, let me show you how this works. Let's do this on QQQ. For the expiry, you could go 1 year or more out. The longer you go, the more expensive it is. But you also get to have more time to be right. Typically, around 400 to 500 days is a good range. For this demo, I will just go with 450 DTE. Next is the strike, and this is the most important part. For LIPS, you want to go deep in the money at around 80 to 90 delta. That's because a deep in the money option is made up mostly of intrinsic value. Intrinsic value is the difference between the stock price and your strike. So for example, if QQQ is at $588 and your strike is at $400, your option already has $188 of intrinsic value per share built in. The intrinsic value doesn't decay. Instead, it moves almost dollar for dollar with the stock. So even if the stock stays flat, you only lose the extrinsic portion and not the whole option. On the other hand, a chip out of the money option has zero intrinsic value. It is made up entirely of extrinsic value, which is the time and volatility. So if the stock doesn't move past your strike before it expires, that extrinsic value will go to zero and you could end up losing everything. For this demo, I'll go with the $400 strike, which is around 90 delta. And instead of paying $58,800 for 100 shares, I only need to pay $21,700. That's 37% of the cost for nearly the same exposure. From here, three things could happen. If QQQ goes up to around $640 and I sell my LIPS early, my profit would be about $4,772. On a $21,700 investment, that's roughly a 22% return, as compared to about 9% if I had just bought the shares. That's the leverage. But if I hold all the way to expiry, my profit drops to about $2,310. That's because the extrinsic value decays over time. So with LIPS, you don't want to hold to expiry. You want to either sell it or roll it while there's still time value left. If QQQ stays flat, I lose the extrinsic portion, which is about $2,900. That's the cost of the leverage, but I still get to keep the intrinsic value. And if QQQ drops below $400, I could lose up to the full $21,700 I put in. But unlike owning shares, my loss stops there no matter how far QQQ falls. If QQQ drops to $300, I will still only lose $21,700, whereas 100 shares would be down $28,800. Now, since we talked about extrinsic value decaying over time, you want to make sure you don't let your LIPS get too close to expiry. So around 3 to 6 months remaining, you can either sell it or roll it into a new one further out. Again, you can ask Moomoo's AI for some suggestion. For example, I want to buy a LIPS call on QQQ. Based on the current volatility and market conditions, is now a good time to buy or should I wait? In this case, the AI actually warns me that the IV is at the 87th percentile right now. That means LIPS are currently expensive. So instead of committing to a full position at once, I should slowly scale in. This is the opposite of cover calls and cash secured puts. For those two strategies, you want a high IV because this will allow you to collect bigger premiums. But for LIPS, high IV would mean you are overpaying. And this is exactly what you check before buying. So those are the three strategies. With cover calls, you can earn extra incomes on shares that you already own. With cash secured puts, you get paid while you wait to buy at your target price. And with LIPS, you get exposure to expensive stocks for a fraction of the cost. If this video is helpful, give it a like and subscribe, and I will see you in the next one.